So Chris, actually, I'll tell a little backstory because you can give a formal intro. Oh, look at that. I'm hopping up on this stool yesterday. Chris, I hurt my back earlier this week. And yesterday I was gingerly getting onto the tool, but I'm positively hopping up. So don't worry, guys, I'm fine. Physio's at the back. You can stand down. I'm good. Right, so I'm not a fan of formal intros, but I think context and stories are relevant. So I think most of you know that I kind of pride myself on, as a small business owner, I'm very financially literate. Not qualified in tax or accounts or anything like that, but I'm very dialed in. I really love that stuff. And so consequently, I'd like to think I've got a relatively high bar. But there's a couple of business owners that I know, that I associate with, that I mastermind with, that I would say his financial acumen supersedes my own. And even though I knew that those two knew each other, I didn't really know that they knew each other. And then by a series of coincidences, I found out they both had the same accountant. And one of them had had the accountant for 20 years, and the other one had had the accountant for 10 years. And neither of them suffer fools. They're very intolerant of anything that's not aligned with their goals. And they both had the same accountant. So I'm like, I've got to meet this guy. But I'm still naturally a skeptic. So I was at an event and I got the chance to meet Chris. And I'm still naturally a skeptic. And I was doing a particular transaction at the time. And I proposed to Chris. Chris said, oh, well, how are you approaching this? Asked me for the outline. And I gave him the outline in my slightly egotistical, arrogant way. I was like, oh, well, I'm doing this, this, and this. And within about 90 seconds, Chris had me tied up in knots because he just went, well, why are you doing it that way? And I'm like, well, when you get a sense, Claire, you're like, oh, hold on, I might have missed something here. I just got a sense from the tone. Oh, why would you do it that way, Dan? And I was like, well, on the back foot, because of this, this, and this, and clearly, that's just makes sense, doesn't it? And it was like, and off the cuff, he just went, well, A, B, C, D, and E, and then like a human calculator literally went, well, if you did it this way, you'd be da-da-da-da, and an exact pounds, shillings, and pence better off. Why would you just do it that? And I had absolutely no answer, James. None. And I was like, that's when I go, this is the accountant for me. I'm in favor. I don't want to be the smartest person in the room. I want to be the dumbest person in the room. So that's my story. So I hold Chris in very high regard, and we've worked together. The years are starting to clock up. It's only a few years now, isn't it? 2, 3 years? Yeah. Don't know, but it's...
With that introduction, I'm in danger of falling on my face.
Yeah. Well, no, I think it's valid and stand behind it. And so with all that said, I wanted Chris to come down and talk about stuff. So I'm gonna pepper it up or set it up specific to exit. I can appreciate it might broaden beyond other tax-related questions because a lot of these things are interwoven. But I'm going to tee up with a few questions with regards to exiting your business to set the tone for today when we talk about that in the next session. So, Chris, with all that said, a lot of people use the term entrepreneur's relief, even though that no longer exists. But people, it's helpful to understand, I think there's some misconceptions about if they're looking to sell their business and how are they going to get taxed on the sale of the business. So what is business asset disposal relief and what are the criteria upon which they need to qualify for that relief?
Okay, so if you start off on entrepreneur's relief that's no longer around, you could sell your business and make a capital gain of £10 million. The first £10 million is taxed at 10%, varied rules. The new rules are encompassed in something called business asset disposal relief, BAD-R. And BAD-R has tightened up those rules. So generally speaking, if you're a sole trader or a partnership, you can broadly claim BAD-R. And if you're a limited company, the rules are a bit tighter, but it has to be a trading company. You have to own ordinary shares, and you have to own at least 5% of the ordinary shares. So in theory, I could have 18 kids and a wife, and we could have 5% of the shares each, and we could all qualify for BAD-R, as long as we are directors or employees of the company. Again, it's got to be a trading company. And again, those rules have to exist for at least 2 years prior to selling your shares. Entrepreneur's relief was 1 year. So BAD-R, what you've got to bear in mind is, do you qualify for all those rules? So to give you an idea, a guy rang me up and said, someone referred me to you. I'm going to sell my business. I'd like to claim BAD-R. I said, do you know the rules? He said, yeah, I know the rules. I said, are you director of the company? Yeah, I've been a director. I've owned the company 7 years, so I've been a director. Is it a trading company? Yeah, we have widgets, so it's fine. And do you own all the shares? Yeah, of course I own the shares, because I own the parent company, so I own all the shares of that company. Sorry, you own the parent company? Yeah. Are you selling the parent company? No. So you've got parent company, trading company. So the parent company owns the shares. This guy owns 100% of that company. So the vendor is this company that owns the shares in that company. Bad R is a personal relief, so it's personal to capital gains tax. So in this instance, if you're not selling the parent company, he doesn't personally own the shares in that company. So what you've got to be careful about is when you structure a business relationship, is you sort of got to check out, do I want a group of companies? And if I do, and I sell a subsidiary, and I'm not selling the parent, then I could, for the sake of argument, have 4 subsidiary companies and a parent company. And if I sell that one, I can't get bad R because I personally don't own those shares. It's owned by the parent. So when you start this, you've got to sort of work out your exit. So a client came to me and he said, well, the trouble was that company was sold, therefore the money goes in that company. If I want to get hold of the money in that company, I can only take it out by dividend or salary. And the highest rate of dividend tax at the moment is 39.35%. So I haven't made a capital gain. If I'd sold it myself and the gain was, say, £1 million, I'd get out at 10%. Anything more than £1 million, if I owned it personally, would be taxed at 20%. So what you've got to say is, well, 20% isn't too bad, even if I don't get bad R. My highest rate of income tax is 45%. So if I make £1 million, then broadly the bulk of that will be taxed at 45% if it's income tax. If it's a capital gain, it's a flat rate. So capital gain doesn't go up, unlike income tax. The more I earn, the more tax I pay, but at a higher rate of tax. So broadly, the first £50,000 of income, I get a £12,570 personal allowance, is going to tax at 20%, so that's 37,500. Then from 50 grand up to 125,000, I'm a 40% income taxpayer. And above that, I'm 45 on each pound I earn above that. But what you've got to bear in mind is there's hidden tax rates. So from an income tax point of view, if I earn more than £100,000, even though I'm in the 40% tax band, for every £2 I earn more than £100,000, I lose my personal allowance of 12,570. So when I get to £125,000, that's 100,000 plus 12,500 pounds times 2, 125,000. I've lost my personal allowance. So that tax band between 100,000 and 125,000 isn't effective 40%, it's an effective 60% tax band that you're in. So there's loads of hidden rates that aren't even published. You think, bloody hell, how did that happen? And you've sort of got a plan for that to make sure that you can maximize. And there are sort of ways of getting around it. But you've got to be aware, and I think it's like Donald Rumsfeld says, there's the known knowns and the unknown knowns. And some people come to me and say, wait a minute, why have I paid 60% tax? No one told me there was a 60% tax rate. I said, well, it's a case of you've got to know in advance and then you can plan in advance. You can pension payments or something like that. You can make it work, but if you don't know in advance, you get your tax bill and it's too late. So with a lot of this stuff, like with capital gains, you might say, well, how does it work? So ideally what you want to do is if you can structure your affairs to make sure you can take advantage of bad R, and the big caveat I'd chuck into this conversation is in 6 weeks' time, I might change my mind completely after the autumn statement.
Thanks,
because
Rachel.
bad R, the government reckons it costs about £1.8 billion in tax relief. So the question you could say is, if there wasn't bad R, would you still sell your business? And bearing in mind, entrepreneurs relief, you've got the first £10 million at 10%. Now bad R is the first £1 million at 10%. Some people might say, if I had to pay 20%, it's not the end of the world. So the government are now saying, well, they may say on 30th of October, what we're going to do is we're going to align capital gains tax rates with income tax rates. Now, you might say, oh, well, that's typical, that's a Labour government. But in fact, 1988, Nigel Lawson was the first person that brought that in. In 1988, what happened is the highest rate of income tax was 40%, and he aligned capital gains tax with that. Now, if you waited 20 years, Gordon Brown then reduced that to a flat rate of 18%. So I wouldn't say 20% is the end of the world, because if I made a capital gain of 100,000, 200,000, 2 million, 20 million, it's still only taxed at 20%. Income tax is graduated. So it depends how they bring it in and when they bring it in, but that's something that's going to change. And the reason it's going to change is if you think that at the moment the government brings in about £780 billion of tax, 75% of that is VAT, national insurance, income tax, which they've said they won't adjust. They might adjust the rates, but that's 75% of your 780 billion. Of that 780 billion, at the moment, we're paying over 83 billion just in interest on the debt. We're borrowing about 100% of GDP. It's about 2.7 trillion pounds. There is no wriggle room. So I won't say you're going to be taxed till the pips squeak, which is what Healy said, but it's going to be painful in some areas. Now, there's only so much they can do, because the 25% of tax that isn't income tax, VAT or national insurance will bring in some tax, but they've got to try and adapt it to make sure that they bring more coffers into the country. So you'll probably find there's new tax. So if you look at, I know, New Zealand, New Zealand's brought in a methane tax. So farmers are taxed on their belching and farting of cows and sheep because they pollute the atmosphere. So there will be, I know, there's already a plastic packaging tax. There may be so tax on, I know, fast foods, salty foods, fatty foods, you name it. Carbon tax, all of these things are going to come in. Problem they've got is if you look down the road, I think, and that's no pun intended, but the government are saying they want electric cars. Well, at the moment, about 75% of the price of petrol is VAT, petrol and revenue tax. If petrol goes out the window, they've got to replace £33 billion somewhere, because if everything's electric, they only charge 5% VAT on if you charge your car at home. Well, compared to 75% tax on VAT, petrol and revenue tax on the price of a gallon of petrol, they're way out. So there's loads of things that they're going to be falling short on. And planning for the future is going to be a tricky one. So
thanks for this really uplifting talk, Chris. Yeah, we're all screwed and everyone's going to get taxed more. Well, related to that, and I already know there's quite a few people in this room that have a multi-group structure. So it might kick off. If you've got questions on that and the selling off of individual pieces, I was having a conversation with somebody in this room. Chris got a couple of very profitable companies and looking at selling off one of them. They might have questions about that, as you mentioned about R. But going down the list, I do want to talk about moving abroad, which was also a topic of conversation yesterday. But there's one person in this room, Chris, who has built up relatively significant assets in a limited company, but the sector's struggling a little bit. So I know that they're considering kind of going, you know what, if I can sell it, great, but I might not be able to sell it. And so a question they might have is, well, could I liquidate? Can't I just liquidate that company or do a solvent liquidation? Because liquidation doesn't always mean kind of an insolvency practitioner. Can they just liquidate that company and still get bad hour or get how would that be taxed from a capital gains perspective?
So if I wake up today and I say, look, I'm pretty damn sure that capital gains tax will be 45% on 30th of October. I've got this business, a really good business, hasn't got many assets, but it's got a ton of cash and debtors. I won't be able to find someone to buy it, but what if I liquidate the company today, which I could do pretty easily because there's just cash in it, there's not like loads of freehold property, and I get the money out and I'll claim bad R on that. So let's say I'm 45. So I can close it down, start another business, and I'll just take the money out and I'll get the 10% rather than 45% after 30th of October. That's what they think. So that is possible, but if I take you back sort of like 10 years when entrepreneurs relief was around, what used to be the vogue is, let's say I've got a ballet school, and I'll say a ballet school because HMRC guidance have that, and let's just say I'm making 200 grand a year. So I have a limited company, I have 50% of the shares, my wife has 50% of the shares, we're both directors, and it's a trading company, so I qualified for entrepreneurs relief. And entrepreneurs relief said, you only have to have that business for 1 year. BADR is 2 years. So what I do is after the end of 1 year, I've made profits of 100 grand each, so it's 200 grand sitting in the bank, and I liquidate the company, claim 10% entrepreneurs relief, which avoids me paying 40% tax, avoids my wife paying 40% tax. So what I've effectively done is I've converted income to capital. And I'll do that every year for 10 years. I make $1 million, she makes $1 million, £100,000 a year times 10. So that's 2 million in my back pocket, 10% tax. Well, that's fantastic. So the government said about 8 years ago, they said, well, we don't like this anymore. We're going to bring in a TAR, Targeted Anti-Avoidance Rule. And a TAR says what you're doing is you're avoiding paying tax, because otherwise you'd have taken that money out by dividend and paid dividend tax on it, income tax. So the company makes the profit, you take the money out of the company. So what we've got to do is we're going to make sure that you can't convert income tax into capital gains tax. So a TAR has basically got 4 main rules. And what it says, if you want to liquidate your company, that's fine, that's not a problem. And it will be a capital gain. However, it's only potentially a capital gain as long as you don't do anything to like that business again for at least 2 years. So you're sort of got to retire. Now, what you can't do is, like that guy previously did with the ballet school, close it down. They call it phoenixism. You close it down after end of 1 year, and year 2, you've got ballet school number 2 limited. And after that year, you got ballet school number 3 limited. So that stops you doing that. And a TAR is a targeted anti-avoidance rule that says you can claim BADR, but you can't go and do that business again for 2 years. So that sort of puts a stop to that rule. But the short answer to the question is, if you wanted to do it today, put your feet up on a desert island and not go into that business for 2 years, is possible. And you do a members voluntary liquidation because you've got no creditors, or you pay the creditors off, pay your corporation tax, whatever's left, you take it out as a capital dividend. If it's not capital, it's being income dividend. So you want it as a capital dividend to make a capital gain. That's sort of the way it works.
So last couple of questions, Chris, and then I want to throw it over to the group because I know that there will be a fair share of questions. Let's talk about moving abroad. So there's somebody in our group who's not here because he's moved to Portugal. And now in his case, he didn't exit, but he moved to Portugal and he got in before the rules changed on 31st December last year, and he's getting apparently 0% tax on dividends from his UK limited company to him in Portugal for the next 10 years. Great. But there's somebody else in our community who's not here because they're on holiday at the moment, who's undergoing an exit, and they've already purchased property in Spain. And so he might say, Chris, why wouldn't I, if I move abroad now and then sell my business, say in the next financial year, why wouldn't I, if I'm tax residents abroad, can I do that and mitigate or minimize the tax bill I'm going to get because I'm now physically, I've moved abroad, but I sell my UK company?
So not paying tax on UK dividends when you're non-UK resident isn't difficult because there's no withholding tax on dividends. There used to be something called ACT, if you go back, which is advanced corporation tax, where the company used to pay tax on dividends. And it could come back again because of the exodus that's going through at the moment of people leaving the country. The problem you've got is the country I'm now resident in, how does that tax my income? That's your question. So in Portugal, the thing that sort of gets me is that a lot of people say, oh, well, the trouble is that we've got these domicile rules and it's really unfair. But what you've got to bear in mind is the UK, about the top 1% of taxpayers in the UK pay about 29% of all tax. Nearly 50% of this country pay no tax at all. So what you've got to bear in mind is that if you look at those of you might not like football, you may have heard of Jim Ratcliffe. So if I said to you, what's the biggest not quoted company in the UK? Anyone got any ideas? Biggest not quoted company in the UK?
He just gave you a clue.
Yes.
Yeah.
Right. So I would probably, before I knew this answer, I probably would have said Dyson. Dyson's got a turnover of about £6.7 billion. INEOS has got a turnover of £67 billion. Jim Ratcliffe left the UK, I think, in 2018, and at that stage he was paying £111 million a year in income tax. So if you piss off people like that, and they go, then someone has got to pay that tax. So the problem you've got is that we have domicile, yeah, sure, we have the domicile rule, but if you go to Portugal, they have habitual non-resident rules. And habitual non-residence rule basically say, if you pay 100,000 euros, you don't pay any more income tax because you're resident in Portugal, irregardless where it comes from. You don't pay capital gains tax and you don't pay inheritance tax. And if you go to Italy, say, I've got some clients that went to Milan, up till then, Italy had the same rule of 100,000 euros. It's now 200,000 euros. But to be honest, 200,000 euros a year is chicken feed compared to what these guys are paying. And all that happens is if you just annoy them and tax it, then someone's got to pay the tax. So like I said, we're paying over 80 billion pounds just in interest on our debt each year, let alone the other stuff. So if you're not careful and everyone clears off, then that's your issue. Now, out of the G20, I think there's only like 3 countries that don't have an exit tax. And an exit tax is if I disappear today, then they will value my business and say, before you leave the country, Chris, Heathrow Airport, can you leave a cheque for this much? And that's an exit tax. And we don't have an exit tax. So there may be something about exit tax. There may be something about withholding tax on dividends because there's so many people leaving because they're fed up of the future regime, what they perceive it to be. Now, if I left the UK today, I could become non-resident for income tax. And the way that works is from income tax, I've got to be out of the country for a full tax year. So if I leave to get a job today, if I come back before the 5th of April 2026, it's as if I've never left and I'll pay income tax on that. If I stay longer, I'm not going to pay income tax and I'm non-resident. But I'm only non-resident for income tax. The capital gains tax, I'm potentially non-resident because you've got to be non-resident for 5 years. So what that means is if I clear off today and I come back before 5 years, then the capital gain that I haven't paid that crystallised on my assets because I sold the shares in my company when I was abroad is all repayable when I come back. So you've got to be away for at least 5 years, and that could change as well. 5 years is quite low compared to some other countries. So you've got to A, decide where you go. So like Jim Ratcliffe went to Monte Carlo, some people are going to Portugal, Italy. So it depends the country you're resident in as to how their residence tax works.
Yeah, right. So just to be clear, I mean, Chris is obviously not suggesting this, but nobody's suggesting break the rules, but you sure as hell better be dialed in on the rules. Remember Sam said yesterday about a partner of his who got double taxed because he wasn't dialed in on the rules? And I mentioned that to Chris and he said, well, did he get advice? And I said, I don't know because Sam told the story off the cuff, but I suspect he did get advice, just probably not very good advice, right? Or the wrong advice. And therefore you fall foul of the rules. So if tax is arguably the largest cost category that you've got, both in your business and personally, you sure as hell want to be dialed in on the rules. So one other piece, Chris, and
Sorry, can I just add to that?
Yeah, you can.
So some things you might not be able to change. So you may be aware that when Boris Johnson was Prime Minister, he sold his house. Now, if you own your principal private residence in the UK, it's not subject to capital gains tax. It's exempt. If you own an additional property, then they're not subject to capital gains tax, but not your principal private residence. However, Boris Johnson was born in New York. He's got a green card, so he's subject to American tax. They've got no principal private residence exemption. So he had a liability to pay tax on that property, even though that property was in the UK and it's a principal private residence. So when you're dealing with double taxation treaty, you need to know the rules in both countries to understand whether it triggers a tax or not. And if there is, say America, you'll get tax relief, but you won't get it for state tax, you get it for federal tax.
Federal.
So you want to bear in mind so there will be a crystallisation somewhere along the line.
Yeah, very good. So last thing I'll ask, and then I'll throw it over to you guys. There's quite a few people in this room. I mean, Chris, I think I told you this, but there's ridiculously diverse business ranges in this room. You know, there's property, there's accountants, there's e-commerce, there's dog training, breeding. There's huge. I could go on. As many people that are in this room, there are almost different types of businesses. There aren't that many physiotherapists. There's not that many that are in the same industry. So, but there's quite a few people in here that their business might not be property, but they own a property, either commercial or personal, that they trade from. So if they're selling their business and they sell the property alongside that transaction, how does that work?
So if I've got a limited company that, say, owns my head office, and I sell the shares in that company, and this is the head office, so I've got all my assets, you can still claim BADR, business asset disposal relief, for that. If you've got it to one side, if you sell it in conjunction with your business, then you can also claim it if you own it personally. If you've got I have to chuckle when I read the Sunday papers. They say that the sale of a residential property is subject to 28% capital gains tax. Well, 28% tax was changed in the March budget. The sale of a second property, residential property, was reduced from 28 to 24. The only rate of 28% capital gains tax at the moment is carried interest. And so at the moment, if I sell a residential property, I'm subject to 24%. Now, you just got to bear in mind that if you're non-UK resident, you still have to pay capital gains tax on the sale of a property. So 2015 was the date that they brought in the rule that said from 5th of April 15, if I'm non-UK resident and I sell a UK property, then they value the property at 2015. So if I sell this property after that date, I can basically work out my capital gain on three ways. I can do it from the valuation of the property at 2015 to the date I sell it. I could take the valuation at the date of sale, because it might have dropped in value, or I could time apportion it over the period I've owned it from to there, on the basis that 2015 is the only period onwards. And they did the same for commercial property if I'm non-UK resident from 2019. So just by being non-UK resident wouldn't assist you with that. And you also got to bear in mind, you say, okay, well, I'll stick all my properties in a limited company. And if 75% of your assets of that company are residential property, then you get clobbered by the same rule. So you don't avoid it. It's just that you can mitigate it.
So, by the way, this falls in, somebody said this yesterday, Chris, somebody said, was asking a question of, if I'm trying to buy a company, I'm trying to sell a company, it's like, it'll be really painful for me to learn all this stuff and all these rules. And then we had a big conversation about how the right team. You can immediately see, I kind of go, I go, oh yeah, I'm really financially literate compared to the average business owner. And then I have a conversation with Chris and I'm like, I don't even know what the hell he's talking about most of the time. Right? But you're going to go, this is why you need to surround yourself with people that are educated, experienced. The two accountants in the room said yesterday, and it's like, if you're looking to sell your company, what kind of accountant do you want? And you're like, and they both said, somebody that's obviously qualified, but suitably qualified, but also has a lot of deal experience. Like they've done this thing many times. And the reason why is there's not only a lot of rules, which, with respect to the accountants in the rooms, no normal person can be expected to understand, but the rules are always changing and evolving.
Does that mean I'm not normal?
Yeah, 100%, 100%. In the best possible way, Chris, in the best possible way. So, and I'm sure some in the room are like me enthralled by this, and someone kind of going, oh my God, it goes over my head and I'm bored to tears. But you've got to get educated, because we're all subject to tax, I think with two exceptions. Everybody in the room, as far as I'm aware, is UK resident. We're all subject to tax, and even the ones that aren't UK resident are subject to tax just elsewhere, right? So you want to get educated, and the stakes get higher when you start playing with bigger amounts of money. So that's a way of saying it's over to you. What questions do you have? I mean, I'll try and ask whatever questions you want. The only caveat that I'll say is, don't give us the 3 hours of story to then get to the question. Just get to the question, and Chris will, if he needs more details in order to give a better answer, he will ask you for the details. So I know a lot of you have things that relate to you. And of course, yes, it is being recorded, and you need to be aware, but I don't plan on publishing the information. But as a comfort, nobody really cares about your tax affairs. They're all just thinking about how this relates to them. So what questions have you got for Chris? So we'll go Sonia first, then we'll go Jana, then we'll go Lisa.
Thank you for that. I was enthralled. What are the kind of common tax clangers that you see businesses make in terms of exiting, but also just in day-to-day operations, year-to-year operations? What are kind of the
I'll just repeat it for the recording. So Sonia said, what are the common tax clangers that you see business owners make, and said yes in exit, but also just in the broader sense. So that was an easy layup for you for a first question, Chris.
So say we stick with capital gains tax to start with. If I'm selling my business, then ideally what I want to do is I want to exit at 10% or 20%. I don't want it to be subject to income tax. So what you've got to be careful of is, I am selling my business, I don't want to leave anything on the table. So if they says, I'm going to buy your business for £10 million, I say, oh, thanks very much. But then I'd say, well, wait a minute, but I've got £1 million of cash in that business. I'm not giving you that. And some people say, what do you mean? They just bought my business. Yeah, but they only need working capital, or they only need that. I want to exit with as much as possible out of that business. I don't want to just say it's, I know, 5 times multiple or something like that. I want my assets to recover, and I'd want to get it out at 10%. Now, you could say, okay, well, let's say I sell my business, and they'll say, I'll tell you what I do. I will give you, I'll pay you off over 6 years. So I'll pay you, let's say, 600,000, and I'll give you £100,000 each year for 6 years. You say, well, that's great. The only trouble is that I don't qualify for BADR. Let's just say that. So I'm going to get 20% on 600,000. That's 120 grand. But you've only given me 100 grand in the first year. So I'm 20 grand down straight away because I've got to pay 100% of the tax on that deal because you've got deferred payment terms. But the crystallisation of the deal is we sign the deal today. It's a bit like me saying to you, I love your car, but I can't afford to pay it all at once. So I'll buy your car today, but I'm going to pay you over 5 years. So then what happens is my tax bill is bigger than the income I've got in the first year. And then what guarantees have I got that you're going to pay me in years 2, 3, and 4? If the business goes down the pan because you tanked it, I've got a big tax bill and I haven't got the income. And so what you've got to do is you've got to protect your downside risk. And a lot of people, when they go into a deal, they don't realise that you've crystallised a gain. So if it's an unconditional deal, your deal is fixed today, and if it's deferred payment terms, they're using your business, and it's probably your profits that's going to pay you back.
So let me just pause there, Chris. Do you get that? Like, as in the price you exit for, that contract is the effective date. So 600 grand, but that's as of today's date. You signed the contract. The fact that you're getting the money later, the taxman doesn't care. You've sold your business for this much. Okay? And then if you don't get the money, and then I just want to ask for a bit more clarity, Chris, because yesterday we spoke briefly a little bit about earnouts. So he said unconditional versus conditional. So if it's unconditional, it's like, yeah, 600,000, and the buyer is obligated, contractually at least, to pay you on these dates. It's 600,000. That's what you've sold for. So that's going to be going on your tax return, or that's your gain. Okay, fine. But how is it taxed? So let's say that same deal, Chris, was, let's be extreme. Let's say the whole value of the business was saying, I'm going to pay you 100% of the profit for the next 6 years, and the business has historically made 100,000 a year. How would that be viewed from a tax perspective?
So what you've got to basically quantify what you're going to get. And if it's an unquantifiable deal, you've got to get it valued. And there's a case called Marin v. Ingalls that basically says it's something called a shows in action, for any of you that are lawyers. And what that means is it's still a capital asset you're selling. So what you're saying is that, I know, they're giving me 10% of the profits the next 6 years. I don't know what the profits are. Well, so I'm not going to pay capital gains tax. Well, A, if it was me, I'd want to pay capital gains tax. And B, I'd want to pay it today. A, I want to pay capital gains tax because it's cheaper than income tax, and B, I want to pay it today because after 30th of October it might be 45%. In which case I want to quantify that, and I want to get it quantified. And if it's a shows in action, that's a capital asset, and that's still taxable. So Marin and Ingalls is a case where you quantify that liability, and therefore you can deduct that from your final exit. What you've got to be really careful of is another boo-boo is my business is worth 600,000, but I earn £1 million salary. So what I'll say to them is, I'm actually going to sell the business for 1.6 million, but I don't want a salary in the first year. So you can pay me 20% of 1.6. But as you can appreciate, HMRC say, well, actually, that would have been income. That £1 million would have been salary subject to PAYE. And you've converted that £1 million into a sale price only subject to 20% capital gains tax, or potentially 10% if you've got BADR on the first $1 million. So what you've then done is, I don't like that, and that'll be subject to challenge by HMRC. So you've got to be very careful of how you slice and dice it, because if you say, like I say, an extreme example, if you extrapolate that, say, look, you're buying me over 5 years and I get £1 million a year salary. So I don't give me a salary for 5 years and add on £5 million to the sales price. Well, then you're taking out what would have been an expense of the business, which would have been subject to PAYE in my hands, and then £1 million would be subject to 45% plus employers' NI at 13.8% payable by them, and employees' NI payable by me. You've converted that into a capital gain at 20%, so your tax bill is less than half what it would have been. So HMRC says, well, I don't like that. So just because you've done a deal doesn't mean to say it's going to work. So you want to make sure that any deal you do sort of just passes muster. But ideally what you want to do is, given the choice, you want to exit as much as possible at capital gains tax, because capital gains tax, broadly, apart from, well, Nigel Lawson 1988 was the highest rate was 40%, but that's because the highest rate of income tax was 40%. Up till then, capital gains tax only came in on the 6th of April 1965, and it was broadly about 30% up to when Nigel Lawson did it. 20 years later, Gordon Brown came in and dropped to 18%. So most of you in this room would probably be aware of sort of 18%, 20% type rates, which is less than half the highest rate of income tax. So that's what everyone will be angling for. Capital gains tax, although they're going to make changes, doesn't bring a massive amount of tax in because it's so complicated. The legislation behind it, as you can probably appreciate from this little vignette of our conversation, it's so complicated, A, to administer and B, to check. So although it brings money in for the Chancellor, it's not massive because the legislation behind it. If you have a revenue inquiry on CGT, it can go on for a long time.
Very good. Very good. Jana, hope that helps on you. And by the way, just again, caveat, it's like, it's not pretty, but you know, I want to deal with reality. Like, I want to be conscious. All right, kind of like, you'll cringe at this analogy, Chris, but it's kind of like, if I've got cancer, how soon do you want to know about it? It's like, as soon as physically possible, because then I can decide what I want to. So if I'm in a, I don't know, a tax structure, if my organization and my companies is messy and it doesn't work, or I don't qualify for the rules, I want to know about it as soon as possible so I can take the appropriate evasive action. All right? Facts don't cease to be facts just because you choose to ignore them. The ostrich strategy is not a good defense. Now, it doesn't mean that HMRC are always right, and yeah, Chris and I could speak here for days just about when they're when they're wrong. But I kind of go. The fact is, there are people looking, and they actually somewhat higher version of myself it likes the fact that they're putting more money into into HMRC to give them the resources to kind of find people that are not playing by the rules. It's like, okay, so avoiding it and just having your head down and go, no, it's 10% is not a good approach. Jana, your question.
Sorry, so mine's got two parts. So at the moment I've got a trading company, but now I'm looking at acquiring another business that's the same, but it's a separate site. So it's not a business that I just integrate. It's actually two sites, and maybe later get other sites as well. So is it better to keep both a separate company? Like if I have, say like children's nurseries, is it better to keep each one, as its own company, or integrate it all together?
Great question.
Thinking of exiting then later on, would that, because then I'll have to be, 5% or more than 5% obviously in each company. So
just to check, you own your trading business, and it's in one location, and you're buying an already trading business in another location. Yes.
I'm taking over other trading businesses, so it is in children's education, but so similar to.
So you're exempt from VAT.
So yes, that as well, but I'm more after the it's limited companies. So it's better to all integrate it into one company and then sell it, or keep it as separate companies.
When you buy your companies, does the vendor have any stake in the business, or do you own it 100%?
So at the moment, I will buy it 100% so that they don't.
Okay, so you don't need to keep a separate entity because they've got a chunk of that.
No.
So then the question is, it would end up expensive if you have a separate limited company for every single nursery. Because the administration cost is that if you've got 10 nurseries, you've got 10 limited companies, you've got 10 corporation tax computations, things like that. You come under what's called the associated company rules, which means you're straight into 25% corporation tax. And then if you've got separate companies, then you've got to concern yourself. Let's assume that they all make profit, because if one of them makes a loss, you don't want a loss in that company because you can't group relieve it. Because if you've got 10 companies not in a group, then that loss can't be offset against one of the other company's profits. So then you'd end up doing management charges. And you've got to be really careful, because if you do a management charge, that may be subject to VAT. And then the company that you charge wouldn't get the VAT back because the management charge isn't exempt. So you'd extra 20% charge. So the problem you've got in your type of business is you could lose 20% quite easily by intercompany management charges on the fact that you won't recover the VAT. The other thing is, ideally, do you own any properties?
No, but that was my next question. So because at the moment I don't own my premises, but if I was to buy another centre that's got premises, how would that then work? If I want to exit, but I want to keep the premises, and
generally what you do is sort of have propco management company. So you want to keep your assets separate. If for the sake of argument, you can't, I'm not a lawyer, but you can't limit your liability for, say, health and safety. If you left one of these cords around here and a child broke their neck, that's a personal liability. You won't be protected by the value of incorporation for incorporation of a limited company. So if something like that happened, you want to make sure that if they went for something, that it's not. So you look at the Paddington, I think it was I think Milton Keynes train disaster, the directors all got sued. So what you want to be careful of is that you actually separate any assets in that entity from the trading entity. But I'd be mindful of the administration costs of all that lot, because it could get quite expensive.
So it's funny, I do have, because when we're asking the question, of course, we want the simple answer. It's like, Chris, tell me, do I do a separate limited company or do I put it all in the same company? And then Chris gives you all the nuances of like, well, you have to consider these things. So if somebody is looking to roll up, buy more sites, if there's not an easy answer, because the answer is it depends, what questions should Jana be asking herself? So let's pretend for a second, Jana goes, I want to buy 5 sites over the next 5 years, and then I want to exit. And at the moment, she's got one limited company because she's got 1 site, and she's about to buy, she's in conversations for buying the second site. What are the questions if it's not obvious, follow this structure because it depends. What are the questions she should be asking herself, or working with her accountant, her legal advisor, etc., what she should be thinking about in order to come to decisions?
Well, I'd start off with the accountant and ask him, I'd probably have a conversation after 30th of October. And I'd probably say, what's going to change? So to give you an idea, say Bad R was disappeared. If I've got a residential or commercial property owned by a limited company, if I own that residential property and I sell it, this is not my PPR, I'm going to pay a maximum 24% capital gains tax. If it's commercial property, I'm going to pay 20%. If I own it in a limited company, I know that the limited company is going to pay 25% corporation tax on the chargeable gain. So that's more than the 24% and the 20%, depending if it's residential or commercial. Then I've got to get the money out of the company, and whether it's capital gains tax or income tax, I'm going to get double tax. The highest rate of dividend tax is 39.35, plus the 25% I've already paid. That's an effective rate of nearly 65% on the company you own 100%.
And by the way, right there, even if you didn't follow the nuances of that, thanks. I'm saying thanks as though it was my advice. Well, I brought Chris here. You can applaud me, Bill. So the concept of that is just why you need to be aware and ask the questions. And so Chris and I have a phone call every month, and that's charged to me in addition to the work that Chris's company does for all my accounts. And basically, it's like, well, why do you have this call? And it's a combination of 2 things. First of all, it's kind of housekeeping for me because I'm a nightmare and organised. So Chris basically shouts at me for not doing the things that I said that I'd send to him. I signed the things that were sent to me yesterday, Chris. Signed them this morning because I'm seeing Chris today. I've got to sign these documents for another company. So, but the other thing is it's like I'm always just bouncing ideas. I kind of go, so Chris has his list of kind of like, all right, Dan, we've got these things that are coming. This is what we're going to do, making sure we're on top because I'm not that organised. So like Chris is going, right, my assistant's on the call to make sure stuff gets filed and sent back. But then part of the call is me going, Chris, I've had this idea. I want to buy this property. I want to do this. I've thought about this. I'm interested in this company. I'm going to do shares. And how would this work? And it's because if you're looking in isolation, you go, well, paying for quality professional advice typically isn't cheap by most people's standards. But you're kind of going, yeah, but try ignoring the advice. It ends up being really fucking expensive. If all of a sudden you go, oh, I could have had that taxed at 20%, but I've ended up with an effective rate of 60% because I didn't think about this several years in advance of doing these transactions.
So what you've got to bear in mind is, unlike solicitor, which is a legally privileged word, so you've got to be qualified to call yourself a solicitor. There's no such thing for accountants. So you could go to an accountant and they could set up ABC Limited, and they probably won't have professional indemnity insurance. They probably won't be a member of a professional body. So if something goes wrong, you've really got no recourse. Whereas we're FCCA, Fellow of the Chartered Certified Accountants. So we have a professional body, our files get checked, we have professional indemnity insurance, so you get some comfort if something goes wrong. So sometimes people come to me and they say, look, I got a revenue inquiry, I went to the accountant, he was cheap and cheerful, but the fines from HMRC are more than I paid him in a year, and then the company's house fines are wrong. And then I say, well, wait a minute, why have you got a property in a limited company? Because you're going to exit at 65%. So if only if you ever look at our website, even though I say so myself, there's a good one about guest houses, about a guy that came for a drink, a friend of ours, and his accountant said, stick the guest house in a limited company because that's what we always do. And I said, but why? They lived in the guest house themselves and rented out 10 rooms. So part of that was their principal private residence, so it was exempt. You get a letting exemption, the new rules for letting exemption is if you live in the property, you claim a letting exemption on an exit. None of this would be applicable if it's owned by a limited company because capital gains tax is an individual tax, not a corporate tax. Then what happens is you can claim capital allowances. The capital allowances can be offset against their income tax.
Could you give an example of capital allowance? Because I think a lot of times people hear that word. What does that mean? Could you give an example?
So broadly speaking, you have something called integral features. So if you've got, say, a guest house, the integral features are radiators on the wall, boilers, solar panels, and you can claim that against your income tax. So if you own, in this case, my suggestion is they own the property personally, not in a limited company, and then the capital allowances can be offset against their income tax liability. But he said, well, in the first year, I'm going to make a loss. Now, probably in year 2, because we're just getting the thing off the ground. But then the next thing that kicks in is that he's just retired and the wife didn't work, so he's retired. If you set up a new business, you can carry the loss back in that new business against your PAYE income for the previous 3 years. So I can create a loss, carry it back, and then you get an income tax refund. And when they exit, they won't get a capital gain on the sale of the property that's subject to corporation tax because it's not in a limited company. And I worked out that probably saved him between £250,000 and £350,000. And his accountant went like that.
Yeah, and it's just another great example. Because if you said, everyone in this room could have a stab as to why did the accountant say, oh, put it in a limited company? And we don't definitively know because we don't know him or her. But like the status quo, the high level concept might have validity. It's got, well, legal liability, stick it over here. So in case like you get sued or something happens, you're not personally liable, blah, blah, blah. But then it's like, you've always got to dig a little bit deeper. Or at least, even if that just confirms, but everyone just kind of looks for the surface level answer and goes, well, that has to be true. And doesn't sit there and go, let me think of the reasons why that's not true or the exceptions to the rule. So at least I can make a decision, Jim. You know, I said yesterday, Chris, I think I said this in this room publicly yesterday. I said, one of the things I like about Chris is he's not afraid to tell you if you're wrong. And the reason why is, as entrepreneurs, we're quite strong, high ego, etc. And I like to think of myself as quite switched on and intelligent, he says humbly. And so I'll come in with a good idea and I'll sometimes steamroller people and say, like, yeah, this is a great idea. So I want to surround myself with people that are smarter than me who aren't afraid to tell me when I'm wrong. And Chris, you've got no qualms to tell me when you disagree with my strategy. Okay. And by the way, just to be clear, that doesn't mean that I'm always right. It doesn't mean that Chris is always right. It doesn't mean that whoever your advisor is always right or wrong. I definitely do not think you should just abdicate and go, oh, you know what? I think I made a mistake. If you're in here and you go, oh yeah, Chris sounds impressive. Yeah, that sounds good. Yeah, great. But then I would say you're being foolish if you just go, well, I'm going to abdicate now. Right? I kind of go, no, use it to educate yourself. Use it to push back. Okay. Right, like that's how you develop skill and acumen. So in the room, if you hear somebody else has shared you, something that was really helpful, Kat, that was said yesterday, oh yeah, that was really interesting. Okay, well, the reason why it was probably helpful is because the person who gave you that bit of advice is coming from experience. Okay, but you still got to dig to check, is it applicable in your circumstances? All right.
So Propco is not a good idea then?
No, and so
Just give her the answer, Chris. She wants the answer, yes or no.
I didn't
Yes.
say Propco is not a good idea. I mean, it's. I'm never going to be able to answer your question sitting here without looking at the numbers. But I mean, you can separate it. I think what you've got to be careful about in your business, we do act for a few nurseries, is losing the 20% on the VAT, because you're worried about your corporation tax and you've lost it out the back door on your VAT with your management charges.
Got to look at it. I have to look at it in a balance. Yep. Lisa.
I have about 7 questions here, so I'm going to try and merge them all into one question. So
That sounds like a 15-minute question. Choose the most important one, Lisa. And I'm going to set it up in advance. I will jump in and cut you off if you get into telling us, taking us to grandma's house.
Is it 2 years trading minimum or 2 years shareholding? And is there any rules on who you dispose to? So can it be a family member? Do all of the shares need to be transferred, or can I do part if another family member has part B? And can you sell to an existing shareholder and still dispose of?
All right, can we just pause there? Because otherwise we might... I know, but Chris might not be able to remember them all to be able to answer them. I was happy that they were actually succinct. But
Yeah, it gets worse.
Shall I answer those?
Yeah.
Okay. So business asset disposal relief says you must qualify with all the rules. So you must be a director or an employee, must be a trading company, you must own at least 5% of the shares, and they must be ordinary voting shares. And all of that has got to exist for at least 2 years prior to selling the business. So let's say I bought your business today and you qualified for those things. And I said, I've got a fantastic business. You're great, but I don't need you anymore. So I'm making you redundant today, which is 10 to 11. And I'm going to buy the shares from you at 5 o'clock tonight. Have you qualified for BAD-R?
Yes, no, I don't know now.
The question is, when you sold the shares, were you a director or employee of the business?
Oh yeah, of course.
The
So
answer is
you have to
no.
sell, you have to sell whilst you're an employee.
Yeah, otherwise you wouldn't qualify. So what happens is that if you're not careful, you can fall foul at the last hurdle.
Okay, but is there any rules on who you dispose of to? So for
No, you
a fair
can
question.
sell to a family member, but it's deemed to be a market transaction. So what that means is that you can't say, well, because it's my mate, I'm going to sell it for £2. But they'll say, well, that's not the market value. So the deemed market value would be introduced if you try and sell at a lower figure.
yeah, I don't think that's the problem. Like it would be, you want to get the money out, don't you? You want a high number because you want to pay tax at a lower rate. But there's no rules that restrict me transferring the shares to a family member. So my daughter, for example,
How old's your daughter?
23.
So she's of the age of majority. She's over 18, so that's
So
fine.
there's no restrictions. And then the next part of it was, how different does the new company need to be if it, or can I be a consultant to the old company? Or do I have to have complete sever?
Well, the idea is that you're not supposed to be involved in the business for 2 years. Because what they don't want to do is this phoenixism, and that's what the TAR related to, Targeted Anti-Avoidance Rule. Because they don't want you to close it down and convert income to capital and do that on a repeat basis.
So Lisa, is what you're saying, if I hear you right, saying, okay, if I want to take some money off the table, but I want to keep the business in my family, Lisa's daughter, who works in the business and has done for many years, then buys it off you, all of it off you, but then of course, Lisa's saying, can I be a consultant to her?
Where's she going to get the money from to buy you?
There's money in the company.
So where's she going to get the money from? Because it's a personal transaction. She's buying the shares off you, not the money in the company.
Yeah, okay.
Is she already a shareholder?
What about a company buyback of shares?
Yeah, that was
What
my
about a company
guess.
buyback of shares?
Yeah, that would work, wouldn't it?
Yep.
You gotta be careful
so
with
now
it.
we're having a three-way conversation.
be
Chris,
careful with
chunk up.
wrongs.
Yeah, I was going to say, well, just chunk up. Could you give an example of what is a company buyback of shares? Because that's where my head immediately went
Okay,
to.
so we acted for one of the largest gas contractors in London. They got a lot of money in the bank, and believe it or not, no one want the business. And there's probably a lot of businesses here that are technically very specialised, and there may not be an obvious person to buy it from, and there may not be an obvious person that wants to buy it. But if there's cash in the business, the company can reduce the share capital. So an obvious example is one that you may know is Sports Direct, Mike Ashley. Mike Ashley, I think, sold, probably got this wrong, but he sold about 48% of the business, floated it, he left with 52%. And then what he did is he got the company's cash to start buying back the shares. So suddenly he owned 52% of, let's say he owned 52 shares out of 100. The company started buying everyone else's shares back. So suddenly he owned 52 shares out of 90. So his percentage of the company's gone up by virtue of a share buyback. But you could do that with your shares as well, as long as you qualified. But there's a 5-year rule for that. So you've got to make sure you comply.
Would it matter if the person that is receiving, or the company's receiving, that the only person left is Class B shares? I think Kerry's got Class B.
No, we did that. Yeah, so the company could buy your shares back as long as there's different classes of shares, as long as you qualify with the share buyback rules, which I say can be a 5-year time limit.
Okay, and they can't be a consultant. You can't take any income then from the company, the new one.
Well,
I'd imagine you could be a consultant, couldn't you?
I don't think that would necessarily matter with the share buyback, but you'd still want to. You'd be claiming bad R, wouldn't you?
Yeah. And then last bit, and I
Oh,
don't
yeah.
really.
Yeah, that's one, and I'm going to throw it over because we're running short on time.
With that all in mind, I've been discussing with my accountant sort of capital allowances of all the bits in the company. Would you do that before disposal or after?
What, you haven't claimed capital allowances on assets in the business?
Do you know what, that bit baffles
Why would you
me.
not do that?
I think we have, but I can't. I'm still trying to get my head around the capital allowances because people keep phoning me. Do you want to do a report on your capital allowances of stuff in the house that we use?
So what is the asset?
It's a personal asset, a house, but it's also a kennel. So all the kennels, all the infrastructure underneath, all the pipes, drains, everything. I don't know. There was somebody keeps calling me about Section 198 capital allowances, and I wondered, would you do that before you do the shares or after?
So what you'd actually do is you could offset that claim on integral features, which is what you're referring to,
so.
against the profits of the business, but that wouldn't affect your exit.
No.
That's against the business
So it wouldn't
profits.
matter if you did it before or after the
Well,
share buyback.
I mean, I don't see why you wouldn't do it at all.
Well,
I mean,
it's
you've got to be careful.
it's the company's thing to do. I mean, and Chris obviously disagreed with me from my kind of layperson point of view. I'm kind of going, if there's tax relief available to you, you're saying, do you want it before or after you remove yourself from the company? I'm like, before, definitely. Definitely.
And also, the longer you
before.
leave it, the legislation may change.
Yeah. And you think that will be in the budget? Do you think that's
I haven't got a
likely
crystal
one?
ball, I don't know.
Oh, come on, Chris. You and Rachel are
It's
best
just a
mates.
fallout.
All right, so
I would do it now. I wouldn't delay.
I'm going to chunk it up. Oh, I was going to say we've got 3 hands. I was going to say 2 questions, so 3 quick questions. Derek.
I'm looking to exit my business in the next 5 years. One option may be a management buyout. Is it better to get that money up front or for them to pay it off over a number of years? What you said earlier worried me about the over a number of years. I could end up paying more tax than I get in the first year.
Chris could answer this question, but you already know the answer.
Well,
Do I want the money now or do I want it later?
So with the management buyout, where are they getting the cash
well,
from?
that's the problem. I don't think that they don't have the cash at the moment.
Okay, so they're going to extract it out of the company.
Yeah.
So they're going to pay income tax on extraction by dividend and give it to you. So they're going to suffer, I don't know, 33 or 39% on the dividend and give it you what's left. So there won't be a lot that's left. Problem you've got, if you sell it today and they buy you on the drip feed, is that you'll crystallize, if it's a unconditional contract, you crystallise it today. So let's say, for easy numbers, you sell it today for £1 million. That goes on your tax return for the year ended 5th of April 25, tax is payable 31st January 26. So if you've only got part of your money by January 26, A, how are you going to pay the tax? And B, what security have you got that you're going to get the rest of the money? If they screw the business up, You might not get it, and then you've already crystallised your tax bill.
Yeah, I thought it was that bad. Thank you.
Well, listen, so it is an additional thought. So we've actually got somebody coming in. I'll say this now because he's agreed to it, but I don't have a bit of ink yet, so I'm not officially announcing it. But I've got somebody who's agreed to come to speak in December, who exited his business for a little over £50 million cash. And but his story is, it's not the same, but it's not a million miles different from a guy who spoke here a few years ago that did an exit. It was a management buyout, and it was £80 million. So Chris asked all valid questions, but I kind of go, well, actually, if I can get the cash now, I'd even sell it for a less price if I could get the cash now. And then you start entering into, I mean, Sam gave an example yesterday about how he did what was effectively it was a leverage buyout. Sam wasn't management. He took over the existing company, but they used debt in order to help facilitate the buyout. Okay, fine. Equally, can the person doing the buy-in, can they raise money by remortgaging, for example? And I would say that, we talked about limiting beliefs yesterday. I said something in this room. I'm quite lucky that I get to see a lot of people's financial information, and I'll tell you, you definitely can't tell. I've definitely learned from experience. I don't know if Chris would agree with this. You've got no clue of people's net worths. Like, it doesn't necessarily correlate with your first impressions remotely, ever. So you're sat there going, yeah, my employees don't have any money. Are you certain? And even if they don't have any money, do they relatives? There's a whole bunch of older relatives that tend to be quite benevolent with their children, especially supportive. If the parent, for example, has money, is my son in this room? Hope not. Yeah, right. If the parent has money, they'll often be extremely flexible about helping one of their children into business, and give excellent terms. And all of a sudden, you start bending over backwards and going, I'll give it the deferral to the employee because it's the only way it can happen. And actually going to go, you know what? Maybe you just have to help coach them a little bit into how they might do it, or at least de-risk it partly so they've got some skin in the game. So it doesn't mean I wouldn't ever take a deferral, but oftentimes they've got no idea how to get the money, but it was actually my limiting belief that prevented me even pushing on them a little bit as to how they might raise the money. Because if they're buying a great asset at a fair price that's going to get them a good return, hell, I'm very supportive to, meet with them and their parents to discuss it and, how we might structure the deal, because that would just make sense. So I don't dismiss it just because, they don't have the money. Probably not true, or possibly not true. I forget who was number two and three. So it was Matt, and then we'll go Darren. Matt.
Yeah, just going back to the property and trading company issue.
Property and trading company, yeah.
Prior to an exit, is there any capital gains implications for moving to a pension first, or is there anything would that be of any?
So capital gains implications of what? Moving the property into a pension.
From the trading company into a pension.
Moving.
Prior to exit.
Good. Good. So is there any capital gain, for the tape, any capital gains implications of I've got a trading company that has a property and I want to move the property into my pension?
Is that more tax efficient than selling it with the business?
Okay.
And what are the implications?
Why do you want to do that?
I'll love it. Why would you do that?
The asset into pension to continue the rent coming in? I don't know what the implications might be.
So why do you want to put it in a pension or own it personally?
Ongoing income.
Yeah, but if you owned it personally, it'd be ongoing income. So why do you want to put it in a pension?
Is there tax savings on income tax within the pension?
You're asking a question with a question there.
Yeah, well, I don't know the answer.
So what you've got to bear in mind, if I own a property, and there's a guy called Mark Homer, you may have heard of, Progressive Property. He came to see me in my office, a client of mine, and we did a video on this. And he said, how should I own a property? I said, well, broadly, you've probably got three answers. You could own it personally, you could own it in a pension fund, or you could own it in a limited company. And we were sitting in my office in Barnes, commercial property, and I said, well, the answer is here. So why do we do it? So I own the commercial property in a limited company, number one. So when I sell that property, I've just explained that the current rate of corporation tax is 25%. companies pay chargeable gains, individuals pay capital gains. So if I owned it personally, selling a commercial property, the capital gain would be 20%. Commercial property in a limited company, 25% corporation tax, then I get the money out of the company, my income tax or dividend. So then I'm going to pay perhaps 39.35% highest rate dividend. Effectively, that's like 65% tax. Or I can own it in my pension fund. Why would I own it in my pension fund? Well, simple, because there's no capital gains tax in a pension fund. Well, that's great. So I sell the property and it's in my pension fund. How do I get it out of my pension fund? Well, pension fund, I'm going to draw it down, subject to PAYE tax. So I'm going to draw it down at possibly 45% because I want 150 grand a year or 125 grand a year. So it's subject to 45% on pension drawdown. Own it in my own name, flat rate, 20% capital gains tax. Which one would you do? And you still get income.
And yeah, and obviously if you own it in the limited company, the income, the rental income is going to go into the limited company.
Yeah.
Right, right. I could dig in because, by the way, I like Chris regularly just, ties me up like this, and then I go away and think about it, normally for a month before we speak again, and then I think of a really good counter-argument, and then I come back to him with a counter-argument, and then he normally knocks that one out of the park in about 3 minutes as well. But so I suppose I want to be clear, circumstances change, so as much as we want this to be a right answer, I love Chris because he just stress tests my thinking. And by the way, and sometimes I'll just disagree or still want to do it that way. And sometimes it's not just sometimes what you're optimizing for isn't the minimal tax. Sometimes there's personal reasons, there's emotional reasons, there's things that you want to do that aren't the most tax efficient for a variety. Okay.
Yeah. So there's loads of things that I would say, well, great answer, but I can't do it. So I haven't got enough money to buy this property from my limited company because no one's going to lend me a mortgage. So I just can't do that. So that one's out. Okay. Well, then you look at another route. So just because it's the tax answer doesn't mean it's the right answer, because there's loads of things in play. There may be, I don't know, I can't get a mortgage in my name because I've already got a property and they won't lend me any more money or something like that. But the point is that, like I say, there's Donald Rumsfeld says there's known knowns, there's unknown knowns. I don't give you the options. And they said, well, no one ever told me that was an option. I thought the option was that or that. But there might be that as well. Well, if I got that, I might pursue that a bit more. Might be a way, I don't know. But you've got to consider it. The easy thing is a bit like sort of, you say, well, I wouldn't have really started here because you've got property in a limited company. And it's a case of, can I afford to take it out? So a client said to me, I can't afford to pay the SDLT and the capital gains tax, I'm taking it out. And I said, okay, on the basis that London property doubles every 10 years, if we have this conversation in 10 years, what do you think the tax will be then?
Yeah, good question. Right, final question, and then we'll be off for a comfort break. Go ahead, Darren.
So have group companies, holding and trading companies.
Yeah, group of companies, holding company, trading companies underneath. Yep.
So I don't know exit strategy, but I will need to do that. Want to know the tax implications of it probably be sold as a whole, based on what it is. But there are two residential properties owned within the company.
So the trading companies own the properties. The holding company owns everything. So the holding company owns the assets, and it also owns the the trading companies underneath.
It all go one. But if I didn't do it that way and sold the residential homes too, if I did it that way.
If you sold the whole lot, yeah.
If one option is sell the whole lot, the other option is to sell two homes, but they're in the holding company. So what would the tax implications?
Great. So one option is saying, right, I've got a holding company that owns physical assets, properties, and it owns trading companies. One option is to sell the whole kit and caboodle, the whole stack. But another option, you just say, well, I'll just realise some money by selling off the properties, the residential properties. Okay. The residential property, but then so option 2 is sell off the properties, but keep the trading companies. Okay. And are the residential properties necessary for the trading? No. So they're just like assets that the holding company's bought with its cash that it's got. Okay. Good. So he's weighing up those option A and option B. What do I think Chris is going to come up with option C, D, and F?
So I can't tell you what the tax will be in 10 or 15 years' time, but let's assume we have a stab at it now. Those properties, do you need them for your business?
Not really, no.
And would you want to retain them personally?
I don't know at this stage.
What,
Okay.
why sell
So-
them though? Was it just about to realise some money, like a semi-retirement?
If I emigrated, or
Say again?
if I emigrated,
If you emigrated, okay, yeah.
Okay. So, I mean, the thing you've got to bear in mind is that my answers are only tax driven, and tax is only part of it. So if you said to me, I think these properties will double in the next 10 years, then I might say, forget about the tax, keep them and sell them in 10 years' time because they're on that trajectory, in which case tax hasn't got anything to do with it. You will pay tax in 10 years' time, but you'll be paying tax on a figure that's far greater than what you've got at the moment. So number one, is it the right time for you to sell? If it is the right time, then the company's going to pay 25% corporation tax on selling those properties. And then the question is, well, how do you get it out? So you might say, well, I need some money, but what you've actually done is the company's got the money, not you. So the company will suffer a corporation tax on selling those properties. So number one is it the right time in the market to sell? You'll crystallise a corporation tax in the company. And then the question is, if you want to access that money, then if you take it out by salary or dividend, you'll have an income tax bill on top of that.
I think that's his way of saying sell the whole kit and caboodle. or not, as the case may be. But it's definitely, yeah. So it's almost like there's two things in here. On the one hand, so this is going to be my wrapping thought, and you're staying around, Chris, or you're around in the break, so definitely jump on Chris in the break and connect with Chris.
Metaphorically speaking.
Yeah, not literally. On the one hand, some of you, this is teeing you up to go think. Planning ahead is, we said, multiple years ahead is very, very, very important. But then some of you are going to go, well, I've already kind of created a situation that's not ideal. I now need to think about what that means, and am I prepared to pay the consequences of correcting that? Because it's not like one's better, one's worse. It's just that there's a trade-off. It's like, okay, well, you can move the properties now and incur the tax. You know, the example of London 10 years later. It's like, well, okay, you can not pay the tax now and you're all good, but in 10 years, you're going to pay a much bigger bill. Do you want a bit paying now or a lot more paying later? And obviously, there's 1,000 nuances inside of that. So, did you enjoy the session? Yeah. All right, very good. So first of all, give a warm round of applause for Chris Wilkins. Okay.
Can I just mention one more thing?
You can mention one more thing.
Just one last thing is, if capital gains tax does double and it's the highest rate of income tax on 30th of October, it's not the end of the world, because what you've got to bear in mind is capital gains tax only crystallises when you sell the asset. If you've got investment properties and you're not in a rush, there's a fixed term parliament of 5 years. You might end up with something like Nigel Lawson, Gordon Brown. That took 20 years, but it went down from 40% to 18%. If you've got investment properties, you don't need to sell it. You don't have to crystallise the gain now. If there's a way of deferring it, you defer the gain, and there may be better news in the future. Taxes, you've got to bear in mind that tax is sort of, if you think of like the Laffer curve, up, down, upside down teacup, basically anything above 40 or 45%, people will just vote with their feet and clear off. When income tax, Labour government in the last 70s, income tax was 83%, investment income surcharge was 15%, an effective tax rate of 19%, 98%, you had a brain drain. And then they said, oh, well, we better change that. So it's not, if you can afford to sit and wait it out, then just don't crystallise the gain.
Little stat just to finish. I'm doing this from memory, so I could be slightly off, but I'm not much off. Because of inflation, etc., the number of millionaires being created globally is steadily increasing. And there are, the vast majority of the countries in the world have a net increase of millionaires resident in those countries. There are two, well, actually, I think there's about 5, but there are a handful of countries in the world that have got net decrease in number of millionaires in that country. Guess who's number 1? No, it's not the UK, it's China, which is quite interesting. And number 2 is the United Kingdom. So that kind of supports. So yeah, at the moment, it would appear, the evidence would seem to appear that people are going, yeah, we're buggering off, and therefore that probably supports that at some point, a government will go, oh, we need to tip this back in the other direction. So on that note, give another round of applause for Chris. Okay, 20-minute comfort break starting back at 11:30, and we'll be going into a plan, going through the process of exiting your business. 20-minute break starts now.
Can I just say, Chris's example at the ballet school was just a lot of dancing around.